Hi there, I'm Andrew Cormack, Credo's Head of Institutional Distribution in South Africa. I'm so pleased that you made the time to join us today. Those of you who followed Credo's fireside chats during COVID lockdown know that Deon Gouws, Credo's Chief Investment Officer, is no stranger to producing digital content, nor to raising thought-provoking and sometimes controversial ideas. He is a prolific author and commentator, as well as being quite active on Twitter. Today is no exception. The seminar that Deon is hosting will be called Of Dwarfs and Giants, an interesting name whose meaning will become clear as Deon speaks. We're going to try to keep the session short to 30 minutes or so it won't take up too much of your day. We hope you enjoy. Over to you, Deon.
Thank you very much for that introduction, Andrew. And thank you also to the audience for joining us today. For those of you who are clients, which I presume is the vast majority, we shall always appreciate your business. Today's presentation will be focusing on two regions of the world that are dear to us at Credo. Firstly, the UK, where Credo was founded 24 years ago, where most of my colleagues and I have been living for the last 2 decades or more, and where in the last few months and years, we've seen a fair amount of political upheaval, ultimately resulting in some economic consequences as well. And then in the second half, we'll be moving across to the US, which is ultimately also a place where we've seen some interesting political developments in the last few years, but from an economic perspective, perhaps slightly less upheaval than the UK, and therefore the reason that today our globally focused portfolios, specifically as far as equities are concerned, are very much centered in the US. The slightly politically incorrect quote, which is the title of this presentation, is ascribed to David Ogilvy, a name which many of you will know, the founder of what was at one point the largest ad agency in the world, Ogilvy and Mather. The Ogilvy name survives to this day, even though the company has gone through some corporate action over the years. At one point, it was all part of WPP. But David Ogilvy was certainly known as the father of advertising in the previous century. And a book that was given to me about 30 years ago now, called The Unpublished David Ogilvy, is arguably the most important book that I've read in terms of my own career. As the blurb on that front page says, it includes the secrets of management, creativity, and success. From private papers and public fulminations, this was handed to David Ogilvy on the occasion of his 75th birthday in 1986. Literally notes and letters and other bits of paper that his colleagues had accumulated over the years in his own words, and a number of very interesting vignettes sort of combined in one book. And one of the stories in the book relates to a board meeting which he organized in the last few years of him still running the company, where he put one of these little Russian dolls in front of each of the board members on the table, and he waited for them to open it. And ultimately, instead of the very smallest doll on the right-hand side there, in the smallest cavity, he included a note, which when people rolled it out, had the following message. It said that if you always hire people who are smaller than you are, we'll become a company of dwarfs. If, on the other hand, you always hire people who are bigger than you are, we shall become a company of giants. I think this is a wonderful lesson for managers around the world, and often something which is probably not that easy to implement. But if we can, hopefully all of us can build businesses that are giants in our fields. This is something which I've thought a lot about in terms of what we've seen in UK government over the last few years. And if you notice, I've added a little asterisk there because I just want to qualify everything I'm going to say next. I don't really want to talk politics. And specifically for those of you in the audience who are supporters of the Tory party, and I'm going to be quite critical of the Tory government in the next few slides. I'm naturally also a Tory supporter. I voted for them a number of times since I first started voting in the UK, probably 18 years ago. Ultimately, it is a political home for myself, for my colleagues, and for most people on this call. Ultimately, we all support small government and fiscal responsibility and business-friendly laws and lower taxes. And we do so because we're capitalists. We're wealth managers, so we have to be capitalists. And I would suggest that those of you watching this today are also capitalists. Otherwise, you wouldn't be watching this. And therefore, as my old headmaster used to say when he called me into the office just before he punished me back in South Africa, 40 years ago when corporal punishment was still a thing. He used to say, this is going to hurt me more than it hurts you. I don't really want to be critical of the Conservative Party, but they've scored a number of own goals in the last few years, and that really what's led to some economic consequences as well, as we'll be pointing out in a few slides' time. So if we just go through what we've seen in the last 25 years or so, we had Tony Blair, who was certainly, well, not Conservative Party, but the last Labour Party government to win an election back in 1997 with a vast majority and a very successful Prime Minister, whether or not you like the Labour Party or not. He won 3 general elections. Ultimately handed over to Gordon Brown in 2007 when the scandal of the Iraq War got too much for him, who then lost his first election a few years later to David Cameron and the Tory party. But you'll see my little icons get smaller. Why? Because even though David Cameron got the most number of seats with his Tory party, they did not win an overall majority like Labour had done previously. They had to enter into a coalition with the Liberal Democrats, and that certainly weakened their hand. And ultimately, because of pressures from within the party, they called the Brexit referendum in 2016, never thinking they would lose it, but they did. And David Cameron promptly handed over to Theresa May, which was ultimately a hospital pass of note. Theresa May read the polls and thought that she was in a strong position to call a snap election, which she did a year later, and promptly lost her majority once again. And she had to enter into a coalition with a DUP. That ultimately led to her own downfall. She had a torrid time in government and took the same hospital pass that she received a few years earlier and passed it on to Boris Johnson, who, to be fair, was a very popular prime minister for the first few years. The polls were very much in his favor. He called his own snap election as well. And there are people who will say that the icon shouldn't get smaller in this case because he won a very big majority. But the reason that I pointed out like that is not because of the majority of the Conservative Party and Boris Johnson's internal strength at the time. It's because of what happened to the talent within government. Because ultimately, Boris Johnson made it very clear to his senior parliamentary members that they had to support his Brexit plans, otherwise there was no place for them in the party. And a lot of talent left the party at the time. Even the father of the house, Kenneth Clarke, who had served as a Conservative Party member of Parliament for 49 years, there was no place for him anymore. And I'm just pointing out that one example. There are tens of the most senior and the most experienced, and some people will argue the most talented members of the party who simply had to leave in its wake. And that's why I used the decreasing little icon there for Boris Johnson the second time. We all know how that ended in a bit of scandal earlier this year. He handed over to Liz Truss, who was only in charge for 44 days, as we all know, and she recently handed over to Rishi Sunak. So the question is, what next and when? Now, I think chances are that Sunak will see out the term until we have another election in the UK in probably about 2 years' time. It won't be much longer, but only time will tell how this develops in the next couple of years. If we just therefore focus on the most recent developments in the last few months, I saw on Twitter the other day that somebody bragged with the fact that his son had lived through the reign of 2 monarchs, 3 prime ministers, and 4 chancellors of the exchequer. And this kid was only 3 months old. Now, one of those chancellors, the second last one that we saw, Kwasi Kwarteng, of course, he shared his dramatic plans with Liz Truss, where they essentially announced lots of tax cuts, which were going to be funded by future borrowing, saddling future generations with a debt that they were going to incur. Now, of course, that was never a great plan. We can see how the cost of government debt responded as a result. You can see there, if you look back at the last 30 years, the UK gilt rate jumping nearly 0.5% in one day, the most dramatic move that we've seen in the last 3 decades. You can also see it if you focus on the 30-year gilt rate. In the summer, when it was becoming increasingly clear that Truss was going to take over, you can see the cost of government debt going up significantly over a few weeks and then the day that they announced their plans, or the week that they announced the plans, just going up essentially a similar differential to what we saw in the few weeks before that. And that's a dramatic move, as you can see, just looking at the scale from around the 1% level to the 5% level, and comparing it to the low interest rates and decreasing interest rates that we've seen for the past decade or more. The Financial Times shared headlines around this, calling this increase in the cost of government debt the so-called moron risk premium. So for the second time today, a bit of a politically incorrect term, but that's not one that I came up with myself. In fact, if you look at a number of mainstream publications, you'll see that they all referred to the moron risk premium. Now, I don't know if you can see my little cursor here. In fact, I can't see it myself now, so I will stop trying to do that. But there's more than one father for this term. Some people ascribe it to the research firm T.S. Lombard. Other people say that the economists Paul Krugman and Dario Perkins came up with it first. So it wasn't actually the FT. They were simply quoting other reputable sources. But be that as it may, we've seen how that has played out over the subsequent few weeks. So as far as the 30-year government bond rate is concerned, we saw that go up by more than 1%, in fact, closer to 1.5%, in just over a week when the political turmoil was at its worst. And by the time that it became clearer that Liz Truss was not going to survive and somebody like Rishi Sunak was likely to take over, it was still there, but to a much lesser extent, only about 0.5% differential. By the time that it became clear that Truss had to go, you can see what happened to the voting intention of the electorate in the UK. For the first time, certainly since I can remember, Labour has a clear majority. More than half the people indicated that they would vote Labour, with the Conservatives being as low down as the low 20s. In fact, there were some polls that suggested if there was a snap election at that point in time, the Conservatives might not even be in the opposition booths, that they may actually fall back to the third position. More recently, and this is a cartoon from the Sunday Times, literally on Sunday, a couple of days ago, and this followed some of the senior ministers or ex-ministers that have announced that they won't stand again, in this case, Sajid Javid, but there's others. People expect as many as 30 or 40 current MPs within the Conservative Party not making themselves available for re-election when the next election rolls on, as I mentioned before, probably in a couple of years' time. And I think this is just ultimately a function of people reading the tea leaves, accepting that they'll probably lose their jobs anyway, that they don't have the stomach for the opposition banks, and the Conservative Party ultimately is very likely to hand over the reins of government to the Labour Party as soon as the next opportunity arrives. Liz Truss set some sort of record before she left. She's the first world figure since Barack Obama to appear on 3 covers of The Economist in only 6 weeks, one when she took over, one in the middle, and then one when she handed over again. And ultimately, that begged the question, who next? And I found this headline from a German newspaper quite instructive. That word on the front page next to Boris Johnson's face means seriously. That's really how the rest of the world saw it. That same weekend, the FT had headlines pointing out that gilts and the pound were wobbling in the face of the fact that for a short while, at least for 24 to 48 hours, it looked very possible that Johnson could take over again. And you could see that over that same weekend, the moron risk premium blew out again. This is the UK gilt index. You can see adding something like 50 basis points over a weekend. But thankfully, sanity prevailed. We saw Rishi Sunak took over, at least a safe pair of hands. And these are the headlines when he took over. Not all complimentary, not all positive. If you look at the top left, for example, the Daily Record called it the death of democracy. If you look at the top right, the Daily Mirror asked, who actually voted for you, bearing in mind that it lost against Liz Truss only a few weeks earlier. And ultimately, a technocratic prime minister, but not a particularly popular one with the UK electorate. Be that as it may, from a market's point of view, it was certainly seen as a positive. And we can see that as soon as the news broke, the moral and risk premium collapsed, and the cost of government debt today is not nearly as expensive as it was in those few weeks of political upheaval. And here we can see what happened over those 2 months, September to November. Essentially, the cost of government debt, the implied bank rate, as per this graph from Bloomberg, is back to where it was before the summer, before we saw, not the summer, sorry, before the budget from Kwarteng and Truss. So most of the moral and risk premium has disappeared. And from that perspective, the country is in slightly better shape. Unfortunately, there's a number of other economic forces which affect the UK negatively and which essentially is a hangover of what we've seen the last few years. There was analysis in the FT a few months ago where they were comparing different classes or different groups of people across the income and wealth spectrum between the UK, the US, Norway, Slovenia. These are the 4 countries that are highlighted there on the left-hand side, left bottom. But all those little gray graphs which are not labeled, a number of other countries in both the developed world as well as emerging market countries. And as this graph points out, on the right-hand side, if you look at the rich cohort of people, the red line is above the light blue line. People in the UK are better off than people in Slovenia. That's what that suggests. But as you move towards the left, to the poorer cohorts, people in the UK are worse off than in Slovenia. And essentially what the message is it's not much fun to be poor anywhere in the world. But if you are going to be poor, you'd rather be poor in a cheap country like Slovenia than to be poor in an expensive country like the UK. And that is why the FT in that same article came up with a conclusion that a country like the UK, which is in desperate need of migrant labor, may soon have to ask new arrivals to accept a pay cut. And that's really something that we'll have to live with. We see it in the UK in terms of service levels in shops and in pubs and in restaurants, which are down from where they were, because a lot of these people that have always depended on cheap labor at the minimum wage are really battling to find people to come and do those jobs. If you look ahead as well, and these are not Credo's figures, this is from the Office of Budget Responsibility and the European Commission, looking at GDP forecasts for next year, and you can see there essentially all the members of the EU looking ahead, and compare that to the UK, which is going to suffer an economic contraction in the next 12 months, whereas Germany, Sweden, and Latvia, perhaps to a lesser extent, also slightly negative, but most other countries still growing, and some countries growing very nicely. So you can see the UK is really battling in terms of keeping up with the EU. If we take this back to Brexit, and it's something I don't really want to talk about too much, once again, I accept that many people in the audience voted for Brexit, and I understand that my own wife voted for Brexit, a number of my colleagues voted for Brexit. But the reality is, if we look back to 2016 when the Brexit referendum took place, the rating of UK stocks compared to those in the US was roughly on par. And in the few years that followed, we can see that the PEs in the US, on average, have increased by about 10 compared to its UK counterparts. Now, I do accept that some of that is just a function of the kind of market we've had, because most of the growth that we've seen until the high of the market about a year ago now has been in the most expensive stocks, the so-called FANG stocks. Most of them are centered in the USA, and therefore that certainly explains some of that differential, but ultimately not all. And it is true that UK companies today, and it's true across the board, it's true when you look at small and mid caps, are simply rated lower than US counterparts. And ultimately the reason for that links to what we saw on the previous slide. It links to the growth that we're seeing and the expected growth that the market is factoring into their forecasts. As far as the currency is concerned, I think there's every chance that the pound, which has been weak against the dollar, may increase in the next few months, maybe even the next year or two, because from a technical level, you can say that the pound is probably oversold. But if you look at it over the past 50 years, you can see that the trend has been in one direction. So on a 50-year view, the pound is essentially halved against the dollar. And I think if we look ahead for the next 10, 20, 50 years, there's every chance that the pound will keep on decreasing compared to the value of the dollar. Why? Ultimately, in a nutshell, the strength of any currency is simply a function of the productive economy, the size and the growth in the productive economy that backs it up. And there's no question that the US has got lots of tailwinds compared to the UK. The US today is about 8 times the size of the UK when it comes to the size of the economy. And chances are that it will keep on increasing in relative terms, and that will have an impact on the currency as well going forward. Just bear one thing in mind. I've only focused on the UK so far and the weakness of the UK compared to the US. But what is true is that the US has actually been strong compared to all currencies. The dollar has been strong compared to all currencies over the last few years. So it's not only a question of the UK being weak, it's simply a question of the US being strong and getting stronger in relative terms compared to the rest of the world. Ben Carlson, who's a very good writer, analyst, researcher with Ritholtz Wealth Management in New York, wrote a very good article about this, funnily enough, dated September 11 this year, where he gave a number of bullet points about why he remained bullish on the USA. Now, the first few are interesting, but perhaps not that relevant. The ones that are relevant from a market point of view are the last few ones, and it related to the energy independence of the USA, the fact that it had the biggest and most dynamic economy in the world getting stronger, the biggest and most diverse stock market in the world, and the global reserve currency. And just as far as that is concerned, I saw this a couple of months ago, and I thought it's particularly interesting about how big the US is in terms of the international currency network. You can see there, if you look at those few bars representing different years, the bottom one in the case of the US dollar, the US dollar is nearly 90% of all flows in terms of cross-currency movements within the global financial system. Now, if you go and add up all these percentages, by the way, those of you who are astute will notice that the percentages do not add up to 100, they add up to 200. And the reason is that for each currency transaction, you need 2 currencies. So the US dollar is practically involved in every cross-currency transaction in the world, 90%, with the rest sharing the other 110. There's only a few that involve 2 different currencies, none of which is the dollar. The one thing which some people will raise is, what about US debt? And this is something which people have been obsessing about for decades now. This is a picture which I found just via Google of the national debt clock affixed to the side of a building near Times Square as far back as 1989. You can see the cars there from the 80s that are driving up and down the streets of New York. That same clock has been updated and today is not very far from where it used to be. It's now in an arcade around the corner from Times Square still. And the first weekend of November, my wife and I happened to be in New York. I went on a pilgrimage to find it. And this is the picture that I took that weekend. So this is only about a month ago. And you can see that the national debt, the updated national debt a month ago for the US was $31 trillion. Now, of course, you don't need to fly to New York to see an update for this. You can actually just go to www.usdebtclock.org, which I've done for your benefit, and taken a screenshot a few days ago. And there you can see the $31 trillion as well. In fact, if you go and audit my numbers, you'll see that this number is a touch smaller than what the physical debt clock suggested about a month ago. Maybe they use a different base, but at least the order number is roughly the same. So this updates when you go to that website, and I invite you to do so. This updates every second, showing you how much the US national debt keeps on going up. And it also points out the fact that for each citizen, each man, woman, and child, they owe $93,000, nearly $94,000 per person. And this is presented to the world by those who are that way inclined as terrible news. I'm an accountant, though. Perhaps I should say I'm an expired accountant. And therefore, when you tell me about debt, I will ask a question about assets as well, because the difference between the two tells you what the equity is of the person or the family or the business in question. And that same website will point out that the national assets amount to more than $500,000 per citizen. So I battled to worry too much about debt of $94,000 when you have assets of more than $500,000. And therefore, I would suggest that US debt is not actually as big a problem as some people like pointing out. What I do find interesting is to see our stock markets have changed over the last 100 years. We can see that in 1899, the US was only 15% of the global stock market, with the UK being somewhat bigger at 24%. And this is how it's changed to the present day. The USA has quadrupled in terms of relative size, and the UK has shrunk. Now, this feeds into exactly what I said before. This is a function of many things, but in part, and in large part, it's a function of the fact that in real terms, the economy, the GDP of the USA has grown so much more quickly and so much more consistently over the last decades than it has done elsewhere in the world, notably the UK. And therefore, to conclude with a sort of giant quote of David Ogilvy, there's another quote which mentions giants, of course, and that is Isaac Newton, who said that if I've seen further, it's by standing on the shoulders of giants. And that is ultimately what we try and do at Credo when it comes to businesses and shares that we pick in our portfolios. If you look at the top 10 of our global equity fund today, there's only half of those names that are American. Those are the ones that I've just pointed out there in red, half of the top 10. Although I would argue that Flutter Entertainment, which I'll say a little bit more in a minute, should really be seen as a US story as well. So I'll come back to that. But 6 out of the top 10 largely American. And then there's 4 others which are listed in the UK. But I think you'll agree that Shell PLC and BAT are not really UK companies. They're very much global businesses that do a fairly small proportion of their businesses in the UK. Admiral is largely a UK-based life insurer, or not life insurer, but insurer. And therefore, you can see that as a UK business, and validly so. And then Prudential PLC, even though the legacy is UK, that business today is more than 3/4 in the Far East as far as earnings and profits are concerned. So really, only 1 out of the top 10 is a UK company as such, and the rest are global with a large focus on the USA. There's some information which you can cross-check to our fact sheets as well about sector allocation. I think just importantly, you can see that the largest exposure there is in financials at the bottom left. And ultimately, that is what has led to some of our success within this fund, and we're comfortable with that position going forward. Just a soundbite or two on our top 3 holdings. HCA Healthcare in the US, a stock that we've owned for years. The largest for-profit hospital operator in the US, even though it only has a market share of about 5%. Now, you might ask, why is a company with a 5% market share the largest operator? The reason is that nearly 80% of healthcare providers in the UK are still state-based. And therefore, in the remaining piece, HCA is strong. You can see in the last bullet point there, they are strong in states like Florida, which is essentially where rich Americans go for their old age and end up spending a lot of money on healthcare in the twilight of their life over a period of 10, 15, sometimes 20 years. And HCA is perfectly positioned to capitalize on that. Flutter Entertainment, another high conviction stock of ours. Really, the growth story here is based on the legalization of sports betting in the US, something which was only allowed by the federal government about 4 or 5 years ago. Since then, no fewer than 30 states have embraced sports betting. But the largest 2 economies in the US still not, although it's pending. In California, which has an economy bigger than the UK, and Texas, which is an economy only slightly smaller than the UK, that's where it's still pending. And we believe that when either or both those come through, hopefully in the next 12 to 18 months, you'll start seeing it flow through earnings very quickly, something which is very good for the prospects of this company and makes us bullish ultimately. And then Microsoft, a company which needs no explanation, a company which most people on this webcast are probably very familiar with. You probably applied yourself in all likelihood. And ultimately, I believe, possibly the most inflation-proof company in the world when people are worried about double-digit inflation. If and when they send us their next bill and the prices go up by 15 or 20%, I don't think Credo will go back and say, listen, let's just negotiate with Oracle first. I think we'll just have to pay that bill. So as I say, we're very much part of that ecosystem. Our business, all our information is moving to the cloud as we speak. And it's a company unlike any other in the global IT business. Our Credo Global Equity Fund, which is now a fund, and you can see this is from an external provider called FE Analytics. The fund size is on the left-hand side here. This was launched 5.5 years ago. So it now has that all-important 5-year track record, and it's more than 110 million pounds worth. And it's done very well over the last year or so. If I point out our performance over all periods, you can see, and this is a recent update, the fund is first quartile over all periods. Now, I'd be the first to concede that it won't always look like this. That's not the nature of investments. Things do go in swings and roundabouts. And I always say to my colleagues, we need to be a little bit more modest about good performance and a little bit more philosophical about relatively bad performance. But the point is that we have something to celebrate today, and I'm extremely proud of the two fund managers, Jared Kahn and Jason Spilkin, as well as the team of analysts back them up for producing these kind of numbers over the last year and more. Specifically over the last year, if you look at the fact that the fund has outperformed its benchmark by something like 13% or so, and it's outperformed the average member of the sector by something like 17%. As I say, it's been brilliant performance. And ultimately, I think this stands us in good stead for the times going forward. If you ask for an explanation about why it has done that well, I will only highlight two small points from our investment philosophy. The way that I like to put it is we invest at the intersection of value and quality. We've certainly seen a value market in the past year or so. This is after us having to swim upstream for the past decade at Credo, and certainly for the first 4 or so years of the life of the Global Equity Fund. But value has come back into favor, and I think with interest rates being higher than they were and likely to remain higher, perhaps not go up too much more from where we see it at the moment or where we will see it in the next few months, but certainly not returning to the very low levels and to the near zero levels that we've seen for years before this. We believe that the time for value will be with us for some time to come, and we remain optimistic on that basis as well. So against that background, I would suggest that it may be time to put a foot or a toe in the water if you have not yet done so, and commit some money to the Credo Global Equity Fund. And if you ask me how, there's a number of platforms that you can do so. I think there's 19 of them listed on this slide, both in the UK and South Africa. Most of the major platforms have accepted us now and are open for business. And against that background, that's really all I wanted to share with you today. As I said right at the beginning, we thank you for your business, and we look forward to meeting you again in person at some point in time. Thank you, and all the best.
Thanks, Deon, and thanks very much to everyone on the call for joining us today. If you have any questions or you'd like to invest with Credo, please contact me in South Africa or my colleague Damien Yeomans in the UK. Alternatively, speak to your local Credo representative or visit us directly at www.credogroup.com. Thanks very much, and goodbye.